Commodities. Taking a look at this past week in review, and let's just start out where we ended up for the week. We'll start out in grain markets. December corn closed at 375 3/4. That's down about 8 cents on the week. Soybeans took the big hit, down 47 cents on the week in the November contract at 9.16. September wheat closed 4 cents down at 5.06 on the week over in the livestock markets. August cattle down 85 cents this week. Looks to be somewhere around 85 cents to a buck lower at 148.72. August hogs expired today at 78.82. That's up $1.50 on the week. The October contract closed stronger as well, up $1.20 on the week. Oil looks as if it is going to close lower, still trading at this time. Last trade somewhere around that 42.30 area. That'd be down roughly about $1 on the week, and most likely if we hold these areas, we're going to be looking at a 9-week lower close in crude. The energies in general still continue the slow grind lower. Dollar index looks to be a little bit weaker on the week. We've been in a range-bound trade for weeks. Looks like we're going to close about a point lower. Again, still trading at this point somewhere around the 96.50 area. One interesting thing of note is the CRB index looks to close lower for the 6th week in a row as well. And the CRB index is a basket of commodities. It's a weighted average out there. Energy's holding the largest share of that, but metals and of course ag commodities are thrown in there. And not only is it a lower close for the 6th week in a row, it's the lowest close in the last 12 years. So it's a little reflection of what is going on here in the commodity world. Let's take a look at grains for the week. Very violent week, or very volatile week, to say the least. Concerns coming in about dry weather early in the week. The devaluation of China's currency putting pressure on all commodities, including corn and beans, on Tuesday as they devalued their yuan. But the big mover this week, of course, was the USDA's monthly supply and demand report that came out on Wednesday. And it was a big shock to everybody out there how bearish that report came in as compared to what the trade was expecting. And mainly was the production side of it. So if we take a look at it, for corn, we were expecting a cut in production, about 200 million bushels, over 200 million bushel cut in production. We were looking somewhere around a 13.33 billion bushel estimate coming out. That would have been down roughly 200 million from last month. We actually upped it to 13.686 billion bushels, and basically that's due to the jump up in yield. We came in at a 166.8 yield from last month. We were expecting somewhere down around 164.5, and we came out at a 168.8 yield from the report, and that was higher than any of the biggest bears had anticipated. So outside the range of estimates, and we did see a harsh sell-off because of that. Obviously, acres were left alone for the most part. Soybeans. Again, we were looking for a cut in production there. Final production numbers came out at 3.916 billion bushels. That's up from last month to 3.885 billion bushels. Again, we were looking for a cut of somewhere around 150 million bushels on the production side. And that came from the yield. Last month, 46. We increased it almost a bushel an acre, 46.9 bushels, and that was up from the average trade guess of around 44.5 billion bushels. And that ballooned that carryout number clear up to 470 million bushels when we were looking at a potential 300 million carryout, or an average trade guess of 300 million bushels for soybeans, compared to last month's 425. So big shocker there. That's why we've seen beans sell off hard. We did see, upon the release of the report, both corn and soybeans touched limit down Wednesday, and we have subsequently closed above those levels for the week. So at this point, there's a lot of concerns about how correct is the USDA at this point. It didn't matter what number the USDA was going to throw at us. There was going to be controversy on yield due to the uncertainties of Indiana, Ohio, portions of Illinois. How bad is it compared to how good is the Western Corn Belt? And that's continue. It's going to continue to be a controversy until this crop is done and put away in the bin. But taking in some states, some of the better states, yield estimates, we had Iowa at 183 is what we're currently pegged at. That's about 5 bushels better than last year's yield currently. Minnesota's pegged at 184. That's almost 30 bushels better than last year. Nebraska is the winner to this point at 187. That's up roughly about 8 bushels from last year as well. States of concern, Ohio, 168, down from last year, 176. Currently, we have Indiana estimated at 158. That would be down 30 bushels from last year at 188. And Illinois at 172, down 28 bushels from their record 200 bushel an acre crop last year. So this controversy will continue. History tells us that the final yield has been within 4 bushels of the August report for the last 20 years. Yet to be determined yet at this point. So as we move forward, what now from these price levels? I think the trade's going to be concerned about weather over the next couple weeks, as there are concerns about the dry areas in the eastern Corn Belt following the heavy rains. We are projected to see some rains come across Iowa over the weekend into the beginning of the week and work their way into northern Illinois, but all eyes will be on the forecast and the radar maps to see if we can get northern Illinois into Indiana and Ohio to see if we can get some rains there. That's probably most likely the near-term driver in the grain futures. Long-term support for corn would be the 360 area in the December contract. That's an area we need to see hold, and $9 in the November bean contract. If those break, we could see the managed money and the tech guys add to the short side of the futures. Moving on, taking a look at the livestock markets. Cattle futures, very disappointing this week. We hit our high right on the open at 9:05 on Monday morning. We ran the August contract clear up to 150.85, only to sell it off the balance of the week. This is following a much stronger than expected cash trade last week of 151 to 153. Little cash has traded so far this week, but we're looking for steady. There has been some 240 in the meat cash trade. There has been 51, 52 trade out there as well. It's been on light volume. Boxes all week, very strong as well. Futures selling off. It's a tough one to figure out right now. It looks to me like it might be a little bit of cleaning of the open interest. We did see open interest drop. Maybe we're seeing some money pull out of this thing. Technically, it was an outside week lower, but part of that part of that sell-off today was a big sell-off. We were able to fight it back a little bit on the close, as Tyson announced they were closing a packing plant in Denison, Iowa. I think that news sparked the computers to sell this thing a little bit. Look for steady cash trade the balance of the day. May lend a little support at the 146 area in the October contract as we start out next week. Hog futures, August expired again today at noon, expiring at a very large gap, $14 gap to the October contract. Cutouts still continue to hold firm here. Production numbers are up 10-11% over last year. Hogs are lighter, but that still only reduces that production number about 1% or so. So we are producing more pork. Exports are down on the year. The dollar is probably not helping that out as well. 62 to 66 seems to be an area that we're locked in the October contract. A breakout of either side of that or a close outside of either of those levels most likely would give us a trend in this market. So if you have any questions about these or any other markets, please feel free to give us a call here at BIS Commodities at 1-800-373-2525 or check us out on the web at biscommodities.com.